Good afternoon, everyone. Nice rally today, recovering from yesterday's deep sell-off. The question when we were speaking on the final bar yesterday was, is this the beginning of the next leg down? And today, rallying a little bit higher with some of the traditional offense leading to the upside, traditional defense more on the downside. So it leaves us once again scratching our head, thinking, how does this fit in with the long-term plan? We've got Larry Pesavento joining us shortly today. This is the final bar. Hello, everyone. Good afternoon. This is Dave Keller, the Chief Market Strategist here at StockCharts.com in Redmond, Washington. This is the final bar, and thank you so much for joining us today. Really appreciate it. We'd love to spend right after the close to spend some time unpacking the price action of the day. As always, the goal here is to connect the short-term movements to the long-term perspective, right? What does today's movement mean relative to the long-term trends, relative to the big picture? Hopefully today will help you unpack some of those things. We've got a really interesting show. We got Larry Pesavento joining us, who's a longtime technical analyst, very capable, and excited to hear his take on what he's seeing. Just to get started, let's just look at today's trading. As I mentioned in the introduction, nice recovery today. Sold off just a little bit at the end of the day. This is a 5-minute chart I'm going to show you very quickly, looking at the last week. This is sort of my go-to, unpack them the last couple of days, see how it fits into the short-term picture. And, all was sort of steady Eddie up and to the right until the last half hour or so. That's when a lot of institutions tend to make some movements. So a little bit of distribution there at the end. That's the last 2-3 days we've seen that. Not incredibly positive for the long-term trend, but overall, looking at the daily chart, we held up just fine and we eclipsed yesterday's high, but didn't close above it. So it's sort of a little more of an inside day type of pattern. Let's look at the rest of the markets and see how things sort of shook out here. Just refreshing the market summary page. We have the Nasdaq up almost 1%, S&P just below that, and then the Dow up 67 basis points. Looking down at some of the major averages, transport's leading the way, and it's interesting. Airlines, which are part of the transport group, of course, had been some of the uglier charts, and all of a sudden, very quickly emerging as not nearly as bad as they had before. So we're really at that volatile period where charts can go from looking very good to very bad in a day or two. It tells you something, I think, about the environment that we're in here. Noticeably, we have small caps at the bottom of the list after mid caps. So small caps still up, but up a lot less than the broader S&P. So it was really the mega cap names, the largest names, sort of driving things today. Looking at the sector picture, we have technology up at the top, followed by materials, financials, energy. So it's kind of a mix of things you would expect sort of in the offense category, and others that are maybe a little less obvious. At the bottom, we had utilities and real estate, so clearly the most defensive parts of the industries sectors down here at the bottom of the list. Semiconductors, one of the best groups out of anywhere, and it's interesting. We've talked a lot on the show about the relative performance of semiconductors and how important that is to get a read on. Last couple of days, right, we've had this nice move, and just looking at the SMH here, the semiconductors ETF on a price basis, not fantastic. And we have this consistent resistance level. It's certainly not bad, but it's not breaking out to new highs like something like home builders, but holding up just fine, holding above the 50-day moving average. But look at how the relative performance just continues to overall hold in pretty well. Has not quite made a relative high for the year, but if and when that would happen, I think you'd see a lot of institutions certainly take notice of that and think of the ramifications for that. Because again, that's the type of group that does well when the markets are doing well, tends to underperform when the markets are underperforming. So a good one to pay attention to. Toward the bottom, we have Big Pharma. The PPH is one of the pharmaceutical ETFs. You also have a lot of commodity related things. So oil services up just above flat, and gold, which is really spot gold here, is flat for the day. So yesterday you had a little more of a rotation to some of the defensive commodity sort of plays, a safe haven like gold, and today we don't really necessarily see the follow through there. And then finally, you see interest rates, high yield sort of mixed here. So you have the high yield ETF up a little bit, the TLT, the long bond ETF down over 0.5%. So overall, sort of a mixed bag there. We're going to jump a little bit to the Mindful Investor Live chart list. And again, this is a list that I've managed for a while now. If you want access to this, just shoot me an email at thefinalbar@stockcharts.com. Happy to send you a link. You can bookmark it, and any updates that I make to it, you will be reflected on your page as well. A couple things I just wanted to highlight here. This is a chart we've looked at before, which is the advanced decline lines, the cumulative advanced decline lines for the broad S&P, the broader New York Stock Exchange, and then mid caps, and then small caps. And as I've pointed out before, we've had this rotation with small cap breadth breaking down first, and then mid cap breadth breaking down next, followed by the NYSE. And we have not seen a breakdown yet in the S&P breadth line. And based on what's happened today, certainly wouldn't expect that to happen on a day like today, where we bounce up a little bit. So, it's an interesting picture where we've seen weakness from small caps and mid caps. That's been a theme we followed for the last couple of weeks. And so if we would get that follow through from the S&P, which we've not yet, but that's something I'd certainly be looking for. It's also interesting to note that even on, as the market's sort of holding in okay, you have plenty of new lows, right? So this is the new highs and new lows on the NYSE. Then this is the new highs and new lows in green and red for the S&P 500. Very few new highs today, only 6 out of the 500 odd companies, but almost 20 stocks making new lows. So again, that's not a raging buy or sell signal by any means, but interesting to note that we still have plenty of stocks that are sort of going to new lows as opposed to new highs. This is a chart that we've referred to a number of times. This is the breadth in the form of the percent of stocks above and below key moving averages, and I think it's worth noting this the 50-day average. So this is the percent of S&P names above their 50-day moving average. And again, on each of these successive pushes higher for the broad markets, you have less lower pushes or less upside with the percent of stocks above their 50-day. A little later, we're going to talk about a section on idea generation. We're going to talk about the scanning engine on StockCharts and look particularly at stocks right around their 50-day moving average. And I think this line is going to make a little more sense when we look at some of the stocks that are actually right at that threshold. So this can actually change very quickly depending on a lot of those names and if they flip to the upside or to the downside. So it's an interesting sort of mix of things to pay attention to. That's a general market recap for today. And again, a nice sort of update, sort of reaction to what we saw on the down day. And as I mentioned yesterday, in terms of how this relates to all the other events, plenty of news flow that's happening to cause these prices to move in the form of earnings, China, elections, all these sort of things. And again, my goal here is to not dig too deep into those stories. I'm going to assume that you follow those. My job is to sort of illustrate visually how those are reflected in the supply and demand of the markets. With this next section, we're actually going to introduce a new segment called Level Up. One of the things that we've talked about here at StockCharts is making sure that all of our users, all the people that use the product, are familiar with all the bells and whistles, all the different tools. And some of my fellow contributors, guys like Greg Schnell, Tom Boley, Julius DeKempener, do such a good job of helping illustrate how they use the product. And if you're newer to StockCharts.com, I'd encourage you to check out on Saturdays. The founder of StockCharts, Chip Anderson, does an all aboard show, which is sort of an intro to the product, and also a deep dive show where he digs deep into certain parts of it. I just wanted to highlight two sort of charts that we've referred to in the last couple days and how to think about them in terms of actually using the platform, how you'd use some of the cool visualization tools that we have. Actually, this came from the mailbag. Thanks so much, one of the viewers that sent this in. After I talked about MACD and PPO, this was earlier in the week, we talked about the MACD indicator, also the PPO indicator, a trend following tool measuring uptrends and downtrends based on long-term moving averages. We were looking at the 21 and 34 week exponential moving averages as the basis for our work. And what they sent me, I had actually showed a chart kind of like this panel here. This is the S&P at the top, the spiders, and then this is the PPO. This is a daily chart, so it's using the 21 and 34 day exponential averages. And this is showing the difference between the two. I tend to show it as a line like this, and I do it by using the settings 21 and 34 bars, but then also 1 day as the signal. And I'll show you how to set that in a moment. What the viewer pointed out to me is actually an Arthur Hill trick, and I tell you, he is one that knows the product better than anyone, even Chip probably, who created it, because he's such a power user. And he pointed out if you switch the signal to 0, it actually turns it into a histogram that for some people visually ends up being a much easier to digest sort of visualization. I thought that was really clever. So if you're not familiar with that, in the settings for the indicators here, you have the parameters, and you just read them 1, 2, 3 across the two settings for the moving averages, and then this is basically a signal line. So if you set that to 0, it makes your chart look like a histogram. It's actually kind of a nice trick. So thanks so much, everyone, for catching that, and for the viewer that's sending that idea. The second thing I wanted to point out, when we had Steve Strauss on the show yesterday, he did such a great job of showing some of the charts he uses on StockCharts.com, and one of them was actually shading the backgrounds. And this is another Arthur Hill trick that he taught me when I first started using the platform and contributing to StockCharts. He showed me how to do some of these rectangles and how to shade things. And if you're not familiar with it, you can circle things and you can write notations, but visually just having like a lightly shaded area ends up highlighting things very, very nicely. And the way you do that is if you go to the annotations here, it brings up the sort of the palette on the left side here, all the different tools that you have. And if you go to the shape tool, you can do a rectangle. So if you want to highlight a certain point, sort of gives you this blocky, depending on your settings, it's going to look a little different. Now, what you can do is have it be hollow, or you can fill it in, and that's what I'm doing. I'm rounding the corners, which is what Arthur tends to do. And then if you click on the color, you can use this little slider and make it sort of a translucent, I guess, sort of color, not opaque and not transparent, but kind of right in the middle. And you can adjust how that looks. And what that does is it gives you this nice little shading to the rectangle. So it doesn't cover up the price action, but kind of highlights it. What's cool is if you want to illustrate something like here, this is the percent of stocks above their 200-day moving average. You can see in 2015, the whole thing kind of came to this more bearish mode. So what I can do is actually just take this whole big rectangle, kind of make a shaded area. I might want to make that red, because it's a little more negative than positive. And now all of a sudden I've highlighted that area on the chart to be a little more red. I can then do another rectangle here to maybe highlight a more bullish sort of configuration, highlighting here with the indicator being in the more positive range. I can make that green and make that sort of translucent as well. So if you see what I did, I basically just made these big rounded rectangles, highlighted the price action. And if you do that, it's a really good way to visualize how the indicators actually relate to what you're seeing on the prices. It's a great way to illustrate bull bear phases. If you're using moving averages, it's a great way to illustrate when markets are above or below key moving averages, or if there's some sort of positioning. A lot of people save, whether they were long or short or long or in cash, a certain stock or certain ETF, and you can highlight it here using the comments then as well. You can explain what this actually means. And then as always, when you're done, hit the X, hit save changes, and then it saves your notations on here. So, a lot of people have a chart list with their brokerage account or with their watch list or their portfolio or something like that. You can use these shaded areas and also some of your notations with the text and with the indicators to really have a good notebook, using the charts not just as an image, not just as a visualization, but as a notebook, right? As a way to actually capture your thinking over time. So that was a segment called Level Up. We'll bring this in randomly over the course of the next weeks and months, just to highlight some of the bells and whistles of StockCharts.com. Make sure you're using it like a power user. We're going to take a quick break, and then we'll be back with my guest, Larry Pesavento. Be right back.
The Chart Watchers newsletter features expert technical commentary about the current market from some of the industry's leading technical analysts. See what's really happening in the markets through their eyes and gain an edge in your own investing. The newsletter is packed full of insightful and educational articles intended to help you become a better investor. Whether you are brand new to charting or a seasoned technical analyst, each edition will provide a wealth of informative content. It's the best way to stay informed on all the latest news, events, updates, and additions here at StockCharts.com. Whether it's a new feature or blog, an upcoming conference, or a special sale, you'll hear it first in the Chart Watchers newsletter.
Hello, everyone. Welcome back to the final bar. This is Dave Keller, the Chief Market Strategist at StockCharts.com. Thanks again, as always, for joining us on our Closing Bell show, unpacking the action of the day and connecting it to the long-term trend. I want to bring on my guest, Larry Pesavento. Larry, I hear you're just getting started in the industry, so congrats so far on your early start.
Yeah, I've been here. It's been this is my third month. I'm actually enjoying it quite a bit.
I'm joking. You've had a fantastic career, and really appreciate you taking some time to share a couple charts with us, talk it through. You sent us two charts, and the first one is an S&P index. What is this telling you?
Okay, this is a 1, 2, 3, 4, 5 expanding triangle, also known as a reverse point wave. That was called that by Wells Wilder back in 1993. He sold it as a standalone system, I think, for around $3,000. But it came right out of Gartley's book, H.M. Gartley's book, Profits in the Stock Market in 1937. That cost $1,500. It was called a T6 pattern. The T was for triangle and happened to be the sixth one. These were the patterns that Dr. Andrew Lowe studied when he wrote his book, The Non-Random Walk Down Wall Street, in 2002. And he proved that these patterns, not only do they repeat, but they are predictable within limits. And what I do as a pattern recognition swing trader is I measure these patterns in price and time to find a place where the market should be making a major top or bottom. What I'd like for you to look at today is the point between 1 and 2, 2 and 3, and 4 and 5. This is why it's so important. Those of you that like Fibonacci numbers, you'll probably like this, because the distance between 2 and 3 is exactly 0.618 of the distance between 4 and 5. And if you reverse the process, the difference between 4 and 5 is exactly 1.618 to the distance between 2 and 3. So it's perfectly mathematically symmetrical. If you look at the cycle thing on the top, this is basically from the work of Jim Hurst. It's basically a static cycle. I just wanted to show that there was 10 months between the major highs, and that's another one that you're looking at. You also see points 1, 3, and 5. That's known as a 1, 2, 3 drive to a top pattern. Linda Bradsky talked about it in Street Smarts. It was also done in Gartley's book and a bunch of other people. But it's a 3 drive to a top pattern. So you have many things telling you that on September the 13th, we had a major top, we believe, in the stock market, and we're getting ready for something, very, very nasty to the downside. Now, here's the fun part. I'm going to get 5 minutes with you folks, and it takes 10 minutes to make you a professional trader. So you're going to have to do some of this on your own time. So here's what you have to do for your homework if you really want to see if this stuff really works or not. Go back to January of 2000, right at the dot-com bubble, and go look at that pattern, and go back and look at this pattern, and you'll see, oh my gosh, that's the same pattern. Well, if that's the case, then that should have happened in October of 2007. And lo and behold, there's the same pattern. The ratios are a little different, but the patterns are there. And that's why you really want to pay attention to what's happening to the market now, because any close below 2820, that's about 100 handles from where we are right now in the S&P, or one tweet, whichever comes first. We get below 2820, you're going to be looking at a move somewhere around 2040. I'm talking about 800 handles, and sometime probably by the end of October, maybe the 25th of October, or maybe into early November. But this is what it looks like. History says that this should work. Maybe it doesn't. I don't know. But all I know is that I would not want to be long stocks faced with this pattern. It's very, very tough to be long in this type of a pattern. As you can see, every time the market rallies since September 3rd, somebody smacks it in the head. So I think we can move on to the gold chart now. And this is going back to the high that we made in August of 2011. The key point to watch here is the head and shoulders pattern that formed between 2014 and 2017. Again, you're looking at perfect mathematical symmetry. You can see the green pyramids that are there. That forms the 3 drive to a bottom pattern, exactly the opposite of what we just saw in the stock indices. It's the same type of thing. And if you measure the time between 2013 to 2014 to 2016, you'll see that that was mathematically, again, spot on, saying the bottom should have been the last week of December of 2015. And then I look at the ratios, of course. The first retracement, major retracement, occurred in December of 2016, when the market came down and stopped exactly at the 78.6% level, which is the square root of 1.27. And then you'll notice again, over on the far right, we made another 78% retracement in August of this past year, when the market hit 1165. Now, the key point here is where I've marked in blue there, where below 1460 is bearish. The reason why I'm saying that is if you look at the last correction that we had during 2019, the one that ended in July, that move was down just about $100 an ounce, and this is pretty much what we've had now. Any move below 1460 will tell us that a major top has been made in the gold market, and I think we'll go all the way back to probably around somewhere around 1350 to 1300, and then we'll see if the market can hold that level and move from there. Now, folks, I want you to realize that I am a technician. I don't read the papers. I don't listen to the news. I look at the price of the bars. If they go up, there's more buying. If they go down, there's more selling. It's that simple. I'm not an Elliott wave person because I can't count to 5. I can only count to 3. So that puts me at a little disadvantage. But with the ratios, proportions, and just looking at simple things that work relatively well, that came right out of Dr. Andrew Lowe's book, you get a pretty good idea of what's really happening in the market. So that's what we're watching here this morning. I don't know if we have time for any questions, but that's pretty much what I wanted to cover. I don't know if my time is up. I only had 5 minutes. And that's over that right now.
It goes quick, Larry.
Yeah,
I will tell you,
sure
hosting
does.
the
Well,
show 5 minutes very quickly.
Yeah, I only know 5 minutes, so I knew I was out of things to say. So that's
those were two really fascinating charts, and I mean, certainly you win the prize thus far in our early history of Final Bar of the most dire S&P prediction that we've had. But I totally see, and the mirror between what we're seeing now and what we saw in the top in 2000. That's a really interesting comparison. Larry
People
Pesavento,
should really go back and look at it and prove it to themselves. I think it would open their eyes.
Right. Larry Pesavento, thanks so much for joining, and would love to have you back down the road for sure. All right. Everyone, that was Larry Pesavento, our guest today. Really interesting long-term view on stocks, on gold, and again, that's a theme that we've had a number of different times, is the value of looking long-term. So thanks for the monthly chart there, Larry. That was fantastic. Moving on here, the next segment we want to hit called the idea generation. One of the things we talked about is just the scanning engine on StockCharts, something that I feel most people could use more regularly, because what it does is it takes some of the guesswork out and just automates some of the things that you probably want to do anyways. I would notice this is on the member dashboard. Hopefully those of you that are longtime StockCharts users have seen some incremental improvements in the product. One of the things that I've been working with Chip and Grayson, the sort of the management team here, are doing some upgrades to the platform. And so this market overview has been upgraded. We've added a sector summary look that's pretty good and allows you to do some really cool deep dives. If you don't see some of those things, just in the upper right, you can click on the little gears and make sure you select these items on here. The one I'll point out also as we get to the scanning engine is the commentary page, and I'm showing you because it features StockCharts TV as well. So on the left, you will see articles from all of our contributors that's using the blog system, people like John Murphy, Carl and Aaron Swenlin, Greg Schnell, Tom Boley, and other really capable technicians. Also StockCharts TV, which you can watch live now right from your dashboard. If we go to the scanning engine here, this is where my scans are, and I want to show you just very quickly one of the scans that I like to refer to. This is one that looks at pullbacks to the 50-day moving average. And if I click on edit, and again, if you're not super familiar with this, I'd encourage you to look at the Chart School articles on how to break down the scanning engine. Also, Chip Anderson did a great job on his deep dive show recently going through scans. And this is basically looking for S&P 500 members that are within 0.5% up or down from their 50-day moving average. I ran that screen, came up with a list of stocks, and I'm just going to fast forward this to the results here, because what I did was I ran the screen and then sorted it by scooter ranking. So the ones at the top are the highest ranking stocks according to sort of the traditional trend following ranking system that we've implemented at StockCharts. So this is showing you stocks that are right about at their 50-day moving average. Now, the way I like to use screens is I like to take the screens to get a list, and then it's a visual exercise. You're looking through the charts to see the ones that fit sort of the ideas that you're looking for. Now, what I will point out is two things from the results of this particular scan that I ran today if you look at the results here, you will find a lot of stocks here in the S&P that are right around their 50-day, but just below it, right? So these, if you think of the breadth chart that we looked at earlier, these would register as below their 50-day moving average, but you can see they're really, really close. And there are 8 pages worth, so it's about 80 odd stocks that fit this criteria of being right around their 50-day, most of which are actually just below it. So things like FISV, Fiserv, also L3 Harris, these are stocks that are just below and, potentially would swing that breadth measure much more bullish, much more quickly. But going down the list, you're going to find a number of things that are actually just above or kind of breaking through. And I want to highlight one here. This is Akamai Technologies. This is part of communication services. It's really an internet, part of the internet group, but becomes Incom Services, part of that newer sector last year. And if you look, this is sort of what I tend to characterize as the fat pitch chart, something that's a long-term uptrend pulling back to the 50-day. You can see we closed below it yesterday, but now back above and finding support right at the 50-day. Again, if you like the long-term story in a name like that, this is sort of the actionable buy point you might be looking for, which is when it pulls back to a long-term moving average. Same thing with VRSK, Verisk Analytics. This is a stock within the industrials group. Same thing, just trading below it, but hasn't really followed through as it broke below the 50-day. So that's another one there. And then Extra Space Storage, EXR, similar type of pattern, kind of testing it from the downside. And then I also like stocks like this, like Global Payments. This is something that has found support around the 152, 154 range, now bouncing back up, potentially closing to a new swing high. And now if it can get above the 50-day, maybe you see the upside follow through that you might be looking for there. So that's a quick run through one of the scans that I pay attention to. Again, we're going to bring this segment back with some regularity to show you some of the scans I pay attention to, show you some of the results, and maybe talk through some of the individual names to see how they relate to the scan, how they should fit into your playbook. In this case, looking for stocks pulling back to their 50-day moving average. Final segment for today is the 3 and 3. This is something we do every day at the end of the half-hour show, breaking down 3 charts that if they are not on your radar, I certainly would strongly suggest that they do so. And the reason is because these are 3 things I think you want to just have your eye on, be aware of, and follow them as they go on. So the first one is something we referred to in the market outlook right at the beginning of the show, which was the S&P 500 with the breadth on the percent of stocks above their 200-day and the percent of stocks above their 50-day. We've talked about this bottom panel a number of times over the last couple of weeks, the successive lower highs that we see on that breadth measure. Here, I actually want to point out the top one. So this is one I've referred to for years. It's the percent of stocks above their 200-day moving average. And I've highlighted with this pink line, the 50% range. So if you look back, when the market corrected in early 2018, really sold off out of the new highs, we can see we eventually got right down to that 50% line a number of times in the spring before we rallied up. When we finally broke below the 50% line, that was an indication that things had really changed into more of a bearish phase. So what we saw the last couple pullbacks here in earlier this year in May to June, and then also in August, we can see we remain just above that 50% line. If we continue to go lower and the S&P nears its 200-day moving average, I think we'll see this come down. And as long as we remain above that 50% level, we're probably in pretty good shape. Second chart of the 3 and 3 is what I call the new Dow theory. This is looking at confirmation or non-confirmation between the S&P 500 and the NASDAQ composite. This is just on a closing basis. I like to pay attention to it because that's how Charles Dow, I think, sort of originally envisioned this. Is about 100 odd plus years ago when he originally came up with these ideas. You can see the S&P has remained above its lows from August. You can see the NASDAQ composite much closer. And if we would see a breakdown of that support level on a closing basis and confirmation with both of those, that would be certainly more of a negative indication than positive. The third of the 3 and 3 is just the gold ETF, the GLD. Larry showed a great long-term view of gold spot and how that has rotated higher. In this case, looking at the GLD, and again, I think of it as if this was a stock, is this the type of thing I would probably want to own? And I'd have to think probably, right? It's a nice long-term uptrend. It's sort of broken out. And if we look at a weekly picture like this, you can see the breakout above resistance above about around 130, 132 on the GLD, now broken higher, pulled back a little bit, but overall in a pretty good phase. And it recently was extremely overbought, which usually means a resumption of the upside momentum once it sort of digests those gains. So we're arguably in that position where it's digesting the recent breakout, the huge momentum move to the upside, pulling back a little bit, and we're waiting to see if we can resume to the upside. So that's the 3 and 3, the breadth, looking at the new Dow theory and looking at the GLD. Thanks again, everyone, as always, for joining us on the Final Bar. You can get to us at any point with questions. Just shoot an email to thefinalbar@stockcharts.com. We review that regularly for questions on the product, on the markets, on anything that I've shared on the show. You can also get to us on Twitter at any point at FinalBarSCTV, and just send any questions to us that way. This is Dave Keller from Redmond, Washington. Have a great day.